Hi, everyone. Welcome back to the podcast. Hope you are doing well and you're recovering well from last night. Me and Dina were just talking a few seconds ago, but for you, it's been an entire day or an evening. Anyway, without wasting much of your time as you're recovering, I shall
Mm,
stop the chit chat and let Dana break into today's topic and try to keep it
mm.
short and sweet. So,
Yeah.
Dana, what's on your mind today?
Sir, there are three types of S's there in the mutual fund. Three types of S.
Mm,
One was
mm,
SIP, another one was
mm,
SWP, another one was STP.
mm,
So I know about very well in the SIP, sir, because I've seen in the mutual funds and then the index funds also I am seeing. Okay, if you
mm,
are investing in a mutual funds, there will be SIP, and then lump sum. Two parts are there. So if you are investing in the SIP, it will be like 500, 100 rupees also. Many mutual funds are giving for the starting amount of range. 100 rupees also there, 250 also there, 500 also there. So the SIP will be, if we are taking the 100 rupees, they will be automatically direct from our bank account. So it will be
mm,
continuous for when we will stop. From there
mm,
also it will be continued. So I know
mm,
about the SIP how it was working, sir. But I don't
mm,
know how the SWP was working, and many of them are asking about what is the SWP. I want to do that, and it will be not in our Gen Z age. So the 30 to 40 in their viewers age also asking that doubt, sir. You need to clarify that. What is the SWP? If you are
I
doing
am
the
very proud
SIP,
of you. I am very proud of you that people who are 30 and 40 are coming and asking you. So you've come a long way, Dana. Because
okay,
just
sir.
a few short months back, a 30-year-old, 40-year-old think you and me are idiots. So 30 or 40-year-old reaching to us shows that we're becoming wise. So I clap you for that.
I'm also, sir. So the
Right.
question will be
So
what?
I'll tell you, it's
Mm,
very simple.
mm,
SIP and STP are the two things for regarding Gen Z.
mm,
SWP, like you rightly said, is for people who are older. I would
mm,
say SWP, that is withdrawal plan, is for
mm.
people even older than me. People in
Ooh.
their 40s should not be looking at withdrawing any funds, right? Unless the market is corrected so badly on their fund, they're losing a
Mm,
lot of money, then maybe they should pull the plug faster than slower. Would be, but I do not know which fund they put, what the loss is or whatever. So
mm.
this is a hypothetical. SIP
Oh,
is your systematic investment, where
mm,
tiffin coffee, what we're trying to do, but
mm,
doing it through a mutual fund company, where the
mm,
company takes your money first, put some money in their own pocket, saying,
mm,
for doing all this work for you, it costs me so much. They put that in their
mm,
pocket. Then they'll
mm,
invest it in their so-called places which they think is the best
mm.
place. They'll keep telling you, trust me, I know what I'm doing. You have to trust them. And they keep giving you money and they keep sipping and keeps hopefully growing.
Oh,
Right?
mm, mm,
In
mm.
passive funds, they will not take so much money and put it in their pocket because there's nothing for them to do. In active funds, they'll take more of your money and put it in their pocket because they're
Mm.
actively helping you make more money. It's the idea.
Okay. Mm, mm,
That is as far as systematic investment plan is concerned.
mm,
Nothing more than it.
mm.
Now, the next one comes to SWP, which is
Sir,
this
in
withdrawal
SAP
plan.
also, one thing is neat, sir. That SAP also is there and lump sum also there, sir. In
Yeah,
mutual fund.
lump sum.
Mm.
Yeah, lump sum is not SIP. That is lump sum.
Oh,
That's
that
something
was
completely
completely
different.
different. Okay.
Yeah,
Okay,
because
sir.
in lump
Mm,
sum, what you have is, let's say you got
mm,
your grandfather gave you money for your wedding and he decided not to get
mm.
married and you have 5 lakhs. You
Mm,
take it and go put it one single shot into
mm.
the mutual fund market, and there also you can invest it actively or passively. Lump
Okay.
sum investing is not something I strongly encourage
Mm,
because lump sum investing in mutual funds doesn't give the kind of returns
mm.
as systematic investing,
Okay.
because that's the way the market works. So if you
Mm,
have lump sum, I would suggest you either to put it in gold if you don't know
mm,
anything, or if you
mm,
know something, to buy
mm,
bonds. You
mm.
know, take that lump sum, buy bonds, take the interest, and do sipping with the interest.
Okay.
Okay, that
Mm,
is as far
mm.
as lump sum is concerned.
Okay.
Now, getting back to
To
systematic
SW.
withdrawal plan,
Yeah.
which is meant for people who are ready to retire.
Mm,
And this is a new way to look at it now because we have entered a bear market phase or the
mm.
beginnings of a bear market. So last year, your retirement fund might have looked very nice. You'd have been very happy you're retiring next year. But suddenly, now you may feel like, oh my God, I cannot retire. So much has been wiped out.
Mm,
Don't worry. There is method to this madness.
mm,
So what you do is you have to adjust the way you withdraw from the
mm,
market. So during bear markets, you withdraw less.
mm.
During good markets, bull markets, you withdraw a little more. So you have to
Oh,
balance.
okay,
So
okay.
when you think
Mm,
about systematic withdrawal plan, You cannot say, I'm going to withdraw this much every year or every month, right? So you have to focus more on what is happening with your fund, where the market is, and based on that, withdraw. People who try and withdraw regularly will find it their principal amount starts depleting faster during bear market and doesn't grow as fast in the bull market because you have less money now, right? So keep that in mind. Most people will think that in systematic withdrawal plan, like in systematic investment plan, where you're putting a fixed money every month in investment, right? That you can withdraw systematically a fixed amount. No,
Okay.
you have to be very much aware how your fund is doing, what the market situation is. Based on that, try and see how to withdraw monthly, quarterly, or yearly. So
Okay.
let's say, and the problem is when you're having a bull run, your mind will not let you withdraw because you've saved all this money and you're seeing it grow.
Okay.
It would
Okay.
have grown 20%, 40%, 50%, it's grown. You'll feel greedy. You'll be like, let it grow some more. I'll only withdraw little. No, you should withdraw more because when the
Oh,
markets turn bad, you won't be able to withdraw.
okay, okay, sir.
You understood? Because if you
Understand,
withdraw
sir.
too much too fast, you'll be
Mm,
removing the capital itself from the market.
mm,
So you have to be smart when you withdraw. So these are
mm.
things you have to take into consideration when you're thinking of systematic withdrawal.
Withdraw. It's also like a EMI plan, sir. That we are
Correct.
paying where initially only interest only we are paying at the initially. At the later
Correct.
end, we paying the principal amount like that.
Correct. The other is the systematic transfer plan.
Transfer plan.
This is one crazy plan.
Mm,
Okay. This is to move your fund in mutual
mm,
funds from
mm,
one fund to another fund you want to move.
mm.
Let's say you want to move from equity, you want to move to debt fund,
That.
or
Mm,
from debt fund, you want to come to equity. But
mm,
how to move it without losing money and to keep your rupee cost
mm,
average.
mm.
So, to keep all that in mind, you have something known as systematic transfer plan.
Okay. Mm,
So let's say we invested 6 lakhs in debt fund. Then
mm.
you set up a systematic transfer plan of 50,000 rupees a month into
Mm.
equity over 12
Okay.
months. So this way,
Okay.
what you do is you avoid all your money going at once. If the
Mm.
market is high
Oh.
or the
Mm,
market is turbulent, you try and
mm,
average it out. So it
mm,
reduces your risk. So
mm,
avoiding lump sum investing in a volatile market
mm,
ensures that you're disciplined about your investing over time and
mm,
helps you earn better returns than a lump sum,
mm,
especially when you're moving
mm,
in debt.
mm.
So this is the main thing. So what
Okay.
is the disadvantage of this? Market can move quickly, faster than you can be withdrawing and moving, right?
Mm, mm,
So you might, because you're investing gradually, you might miss opportunity. You will feel all
mm,
this FOMO will happen because it's
mm,
normal.
mm.
Okay. And sometimes you must also remember that systematic transfer plan is only possible within the same mutual fund company. So let's
Okay.
say
Mm,
you've bought Dana High
mm,
Growth Fund, then you
mm.
want to move to Dana's Debt Equity Fund, you can do.
Okay. Okay.
Let's
Mm.
say you bought in Dana High Growth Fund,
I
then you
growth
want to
fund.
move to Vinod's Useless Fund. You want to move it,
Not sir.
you
I
cannot
growth
you
to I
cannot
growth.
okay, you cannot put
Mm,
this
mm.
systematic transfer plan. So
Okay.
those things you must keep in mind. So these
Only
the best
the same EMC only we can move. Oh,
within the
mm,
same company, right?
mm,
So as management.
mm,
So what is the purpose? Transfer
mm,
of money between funds is what STP is for. Who is it
mm,
best for? It is for investors who want to invest slowly, moving from here
mm.
to there. So each time you transfer, it is treated as a redemption. So taxes will be put accordingly.
Oh,
Okay, so
that
remember
also keep
that.
in mind.
Yeah. So, but in SWP, it's not, it's a withdrawal. It's meant for investors
Mm,
who want regular income. So, who are
mm,
planning to retire, who don't
mm,
have any other source of income.
mm.
And the withdrawal amount is taxed only when you withdraw. And it's ideal
Mm.
for people who are retiring. Okay. So,
Okay,
this
sir.
is what STP
Mm,
and SWP. This is all
mm,
only, remember, all these
mm,
S's are only relevant in mutual funds. When you look
mm,
at what we are doing, which is directly investing into the market,
mm,
we can do whatever we want.
mm.
We are not we are our own management, asset
we
management
are
company
we are
manages.
active fund
Yes,
manager.
we
We
are
are only.
active fund managers for our own funds. So you may decide, you can take how much you
Mm,
want, put it in your pocket.
mm.
Like Arun always puts all 100 rupees into his pocket, puts nothing in the market. Same way, you can put all 100 rupees in the market and not put anything in your pocket.
Okay.
So
Mm,
these things we don't talk about it much because
Mm.
we do not talk about investing in mutual funds at all.
Correct.
So people who do invest in mutual fund do look at our channel and find our channel like wanting this a lot.
Mm.
But the main reason we don't talk about mutual fund investing is we don't encourage it. So if I go on talking about something, don't do,
Mm.
the human mind is such that it will go do it. Like my daughter. If I tell my
Mm.
daughter, don't touch that, she'll be like, I want to touch that.
Touch.
Why? Why? Tell me. Let me just touch once. If I say you'll hurt yourself, please don't do it. She'll keep on saying, but why? What will happen?
Mm.
Will I die? Like that, those questions. Same problem. If I keep on saying, don't do mutual fund, don't do mutual fund every day, everybody
Mm.
in our group will feel like, just especially you Gen Zs, will go running to it. So I don't talk about it.
After
And the
writing
main
also
reason I
comes,
talk about, yeah, and the reason I don't talk about it is nothing wrong with it. It's
Mm.
just that you can make more money for yourself by directly
Mm.
investing in the market. Why pay
Okay.
someone to manage your fund when you can manage it yourself?
Okay, sir. For that also, I have one example, sir. I have taken the SBI Gold ETF.
Mm.
There is a SBI Gold ETF. Where we are safely into the PSC stock. Okay, it was a SBI Gold ETF. From taking, if we are individually investing in the ETF, then the Gold ETF SBI is also good, from my opinion. And then, if I'm going for the mutual fund for the SIP, SWP, STP in the SBI Gold Direct Fund, so and I'm taking the old shareholding pattern or the funds holdings. I'm taking the fund holding. The SBI Direct Gold Fund, it was purely holding the SBI Gold ETF. That's it. Only one holding, that was 100% in the SBI Gold ETF. And then the fund manager also, we need to spend some fees. So for the same STP also, one was if one was in the SBI contra fund or SBI hybrid fund, if they are moving into the SBI Gold Direct Fund, so the STP also same. So they are moving the SBI Gold ETF into the another SBI Gold ETF. So they are
Right.
converting that SBI Gold ETF. So for that, we can do that in our own. Like we are taking the
Yes,
gold ETF separately.
correct.
I'm also searching for it for sir. For the Gen
Correct.
Z
And
level, I
listen,
don't know
listen.
the
y-
40s
Yes,
and
and
50s age.
realize each time you buy and sell,
Mm,
right? Tax is one thing, but
mm,
then you have to pay that guy money more in his pocket.
mm,
Let's say the same fund, you
mm,
buy one unit, then you
mm,
sell that unit, and then you buy that same unit again. Some more money keeps going in his pocket. So
mm,
all these mutual funds, they also need to make pay bills. They have to have
mm,
fan, electricity running. They need to
mm,
buy Jaguar car. So
mm,
they will all be doing this turning business.
mm,
And some of it is they make it so confusing purposely that you don't
mm,
know what's happening.
mm,
In equity, it's very simple. You go
mm,
put money, buy one stock, the stock is in your
mm,
account, finished.
mm.
Dividend they pay comes to my account, finished.
Finish.
NAV like this, like that, up and down, the time where off market hours on, today is a holiday, the window, then I will, all this is purely crazy.
Mm,
So I don't know if you want
mm,
to go, because the reason why we don't invest in mutual funds is, I mean, we invest in mutual funds is because you
mm,
say you don't have the time to learn about stocks. You
mm,
don't have the time to buy the companies, but you have the same amount of time to learn about the more complicated mutual funds. So it
mm.
kind of defeats what you're saying. I'm like, wait, you don't want to learn 1 + 1 is 2, but you want to do calculus. Okay. But don't you need to know 1 + 1 is 2 first?
Mm,
Because if you end of the day, everyone's buying shares. Even mutual fund is
mm,
buying shares. If you do not know what shares he's buying, how he's buying it, then what are you doing?
mm.
So so this is what the problem, the crux of it is for me. Anyway.
Okay, sir. Mm,
This is an interesting conversation me and Dana had. I hope you found it
mm,
informative and entertaining as always. We dragged on a little more and we got a
mm.
little in our sat in our thrones and we were lecturing a little bit. So we're sorry about that. We didn't mean to put down people who invest in mutual funds. Please do invest. Wherever you invest, I'm happy you're investing as long as you're doing with knowledge and not guesswork. That is my Dana, and my only hope is that we want you to be learned investors, not guessing investors. Even if you're a
Mm,
beginner, take the time to learn and invest and not to invest blindly. Thanks for watching the podcast. Hope you have a wonderful Sunday as you
mm.
recover and get back to it. Tomorrow's another Monday, another market day. Friday was off, but Monday we're on. So try to do some tiffin coffee again and hope you have a wonderful week ahead. And me and Dana will be back in studio next podcast and we'll talk together from there. Thanks for watching the podcast, guys. See you next time. Bye.
Bye.